Government debt is the debt owed by a central government. By contrast, the annual government deficit refers to the difference between government receipts and spending in a single year, that is, the increase of debt over a particular year. Government debt is one method of financing government operations, but it is not the only method. Governments can also create money to monetize their debts, thereby removing the need to pay interest. But this practice simply reduces government interest costs rather than truly cancelling government debt, and can result in hyperinflation if used unsparingly. Governments usually borrow by issuing securities, government bonds and bills. Less creditworthy countries sometimes borrow directly from a supranational organization or international financial institutions. As the government draws its income from much of the population, government debt is an indirect debt of the taxpayers. Government debt can be categorized as internal debt and external debt. Another common division of government debt is by duration until repayment is due. Short-term debt is generally considered to be for 1 year or less, long-term is for more than 10 years. Medium-term debt falls between these two boundaries. A broader definition of government debt may consider all government liabilities, including future pension payments and payments for goods and services the government has contracted but not yet paid. History. During the early modern era, European monarchs would often default on their loans or arbitrarily refuse to pay them back. This generally made financiers wary of lending to the king, and the finances of countries that were often at war remained extremely volatile. The creation of the first central bank in England, an institution designed to lend to the government, was initially an expedient by William III of England for the financing of his war against France. He engaged a syndicate of city traders and merchants to offer for sale an issue of government debt. This syndicate soon evolved into the Bank of England, eventually financing the wars of the Duke of Marlborough and later imperial conquests. The establishment of the bank was devised by Charles Montague, 1st Earl of Halifax, in 1694, to the plan which had been proposed by William Paterson 3 years before, but had not been acted upon. He proposed a loan of £1.2 million to the government. In return, the subscribers would be incorporated as the Governor and Company of the Bank of England, with long-term banking privileges including the issue of notes. The Royal Charter was granted on the 27th of July through the passage of the Tonnage Act 1694. The founding of the Bank of England revolutionized public finance and put an end to defaults such as the Great Stop of the Exchequer of 1672, when Charles II had suspended payments on his bills. From then on, the British government would never fail to repay its creditors. In the following centuries, other countries in Europe and later around the world adopted similar financial institutions to manage their government debt. In 1815, at the end of the Napoleonic Wars, British government debt reached a peak of more than 200% of GDP. Government and sovereign bonds. A government bond is a bond issued by a national government. Such bonds are most often denominated in the country's domestic currency. Sovereigns can also issue debt in foreign currencies. Almost 70% of all debt in 2000 was denominated in US dollars. Government bonds are sometimes regarded as risk-free bonds, because national governments can raise taxes or reduce spending, and in extreme cases they can print more money to redeem the bond at maturity. Most developed country governments are prohibited by law from printing money directly, that function having been relegated to their central banks. However, central banks may buy government bonds in order to finance government spending, thereby monetizing the debt. Government debt, synonymous to sovereign debt, can be issued either in domestic or foreign currencies. Investors in sovereign bonds denominated in foreign currency have exchange rate risk. The foreign currency might depreciate against the investor's local currency. Sovereigns issuing debt denominated in a foreign currency may furthermore be unable to obtain that foreign currency to service debt. In the 2010 Greek debt crisis, for example, the debt is held by Greece in euros, and one proposed solution financial economists is for Greece to go back to issuing its own drachma. This proposal would only address future debt issuance, leaving substantial existing debts denominated in what would then be a foreign currency, potentially doubling their cost by country. Public debt is the total of all government borrowings less repayments that are denominated in a country's home currency. CIA's World Factbook lists only percentage of GDP. The debt amount and per capita is calculated with GDP and population figures of same report. Using a debt-to-GDP ratio is one of the most accepted measures of assessing the significance of a nation's debt. For example, one of the criteria of admission to the European Union's euro currency is that an applicant country's debt should not exceed 60% of that country's GDP. US data exclude debt issued by individual U.S. states, as well as intragovernmental debt. Intragovernmental debt consists of Treasury borrowings from surpluses in the trusts for federal Social Security, federal employees, hospital insurance, disability and unemployment, and several other smaller trusts. If data for intragovernment debt were added, gross debt would increase by about one-third of GDP. The debt of the United States over time is documented online at the Department of the Treasury's website treasury.gov, as well as current totals, outdated tables, municipal, provincial, or state bonds. Municipal bonds, munis, in the United States, are debt securities issued by local governments, denominated in reserve currencies. Governments often borrow money in a currency in which the demand for debt securities is strong. An advantage of issuing bonds in a currency such as the US dollar, the pound sterling, or the euro is that many investors wish to invest in such bonds. Countries such as the United States, Germany, Italy and France have only issued in their domestic currency. Relatively few investors are willing to invest in currencies that do not have a long track record of stability. A disadvantage for a government issuing bonds in a foreign currency is that there is a risk that it will not be able to obtain the foreign currency to pay the interest or redeem the bonds. In 1997 and 1998, during the Asian financial crisis, this became a serious problem when many countries were unable to keep their exchange rate fixed due to speculative attacks. Risk. Although there is always default risk, lending to a national government in the country's own sovereign currency is often considered risk-free, and is done at a so-called risk-free interest rate. This is because, up to a point, the debt and interest can be repaid by raising tax receipts, a reduction in spending, or failing that by simply printing more money. It is widely considered that this would increase inflation and thus reduce the value of the invested capital. This has happened many times throughout history, and a typical example of this is provided by Weimar Germany of the 1920s, which suffered from hyperinflation due to its government's inability to pay the national debt deriving from the costs of World War I. In practice, the market interest rate tends to be different for debts of different countries. An example is in borrowing by different European Union countries denominated in euros. Even though the currency is the same in each case, the yield required by the market is higher for some countries' debt than for others. This reflects the views of the market on the relative solvency of the various countries and the likelihood that the debt will be repaid. Further, there are historical examples where countries defaulted, i.e., refused to pay their debts, even when they had the ability of paying it with printed money. This is because printing money has other effects that the government may see as more problematic than defaulting. A politically unstable state is anything but risk-free as it may, being sovereign, cease its payments. Examples of this phenomenon include Spain in the 16th and 17th centuries, which nullified its government debt 7 times during a century, and revolutionary Russia of 1917, which refused to accept the responsibility for Imperial Russia's foreign debt. Another political risk is caused by external threats. It is mostly uncommon for invaders to accept responsibility for the national debt of the annexed state or that of an organization it considered as rebels. For example, all borrowings by the Confederate States of America were left unpaid after the American Civil War. On the other hand, in the modern era, the transition from dictatorship and illegitimate governments to democracy does not automatically free the country of the debt contracted by the former government. Today's highly developed global credit markets would be less likely to lend to a country that negated its previous debt, or might require punishing levels of interest rates that would be unacceptable to the borrower. U.S. Treasury bonds denominated in U.S. dollars are often considered risk-free in the U.S. This disregards the risks of foreign purchases of depreciation in the dollar relative to the lender's currency. In addition, a risk-free status implicitly assumes the stability of the U.S. government and its ability to continue repayments during any financial crisis. Lending to a national government in a currency other than its own does not give the same confidence in the ability to repay, but this may be offset by reducing the exchange rate risk to foreign lenders. On the other hand, national debt in foreign currency cannot be disposed of by starting a hyperinflation, and this increases the credibility of the debtor. Usually small states with volatile economies have most of their national debt in foreign currency. For countries in the Eurozone, the euro is the local currency, although no single state can trigger inflation by creating more currency. Lending to a local or municipal government can be just as risky as a loan to a private company, unless the local or municipal government has sufficient power to tax. Further, local government loans are sometimes guaranteed by the national government, and this reduces the risk. In some jurisdictions, interest earned on local or municipal bonds is tax-exempt income, which can be an important consideration for the wealthy. Clearing and defaults. Public debt clearing standards are set by the bank for international settlements, but defaults are governed by extremely complex laws which vary from jurisdiction to jurisdiction. Globally, the International Monetary Fund can take certain steps to intervene to prevent anticipated defaults. It is sometimes criticized for the measures it advises nations to take, which often involve cutting back on government spending as part of an economic austerity regime. In triple bottom line analysis, this can be seen as degrading capital on which the nation's economy ultimately depends. Those considerations do not apply to private debts. By contrast, credit risk determines the interest rate, more or less, and entities go bankrupt if they fail to repay. Governments need a far more complex way of managing defaults because they cannot really go bankrupt. Albeit in some cases a government may disappear, as it happened in Somalia, or as it may happen in cases of occupied countries where the occupier doesn't recognize the occupied country's debts. Smaller jurisdictions, such as cities, are usually guaranteed by their regional or national levels of government. When New York City declined into what would have been a bankrupt status during the 1970s, by the mid-1970s a bailout was required from New York State and the United States. In general, such measures amount to merging the smaller entity's debt into that of the larger entity and thereby giving it access to the lower interest rates the larger entity enjoys. The larger entity may then assume some agreed-upon oversight in order to prevent recurrence of the problem. Economic policy basis. According to modern monetary theory, public debt is seen as private wealth and interest payments on the debt as private income. The outstanding public debt is an expression of the accumulated previous budget deficits which have added financial assets to the private sector, providing demand for goods and services. Adherents of this school of economic thought argue that the scale of the problem is much less severe than is popularly supposed. Wolfgang Stutzel showed with his Salden mechanic how a comprehensive debt redemption would compulsorily force a corresponding indebtedness of the private sector, due to a negative Keynes multiplier leading to crisis and deflation. In the dominant economic policy generally ascribed to theories of John Maynard Keynes, sometimes called Keynesian economics, there is tolerance for fairly high levels of public debt to pay for public investment in lean times, which, if boom times follow, can then be paid back from rising tax revenues. Empirically, however, sovereign borrowing in developing countries is pro-cyclical, since developing countries have more difficulty accessing capital markets in lean times. As this theory gained global popularity in the 1930s, many nations took on public debt to finance large infrastructural capital projects, such as highways or large hydroelectric dams. It was thought that this could start a virtuous cycle in a rising business confidence, since there would be more workers with money to spend. Some have argued that the greatly increased military spending of World War II really ended the Great Depression. Of course, military expenditures are based upon the same tax and spend fundamentals as the rest of the national budget, so this argument is little to undermine Keynesian theory. Indeed, some have suggested that significantly higher national spending necessitated by war essentially confirms the basic Keynesian analysis. Nonetheless, the Keynesian scheme remained dominant, thanks in part to Keynes' own pamphlet How to Pay for the War, published in the United Kingdom in 1940. Since the war was being paid for, and being won, Keynes and Harry Dexter White, Assistant Secretary of the United States Department of the Treasury, were, according to John Kenneth Galbraith, the dominating influences on the Bretton Woods agreements. These agreements set the policies for the Bank for International Settlements, International Monetary Fund, and World Bank. The so-called Bretton Woods institutions, launched in the late 1940s for the last two. These are the dominant economic entities setting policies regarding public debt. Due to its role in setting policies for trade disputes, the World Trade Organization also has immense power to affect foreign exchange relations. As many nations are dependent on specific commodity markets for the balance of payments they require to repay debt, structure and risk of a public debt. Understanding the structure of public debt and analyzing its risk requires one to assess the expected value of any public asset being constructed, at least in future tax terms if not in direct revenues. A choice must be made about its status as a public good. Some public assets end up as public bads, such as nuclear power plants, which are extremely expensive to decommission. These costs must also be worked into asset values. Determine whether any public debt is being used to finance consumption, which includes all social assistance and all military spending. Determine whether triple bottom line issues are likely to lead to failure or defaults of governments, say due to being overthrown. Determine whether any of the debt being undertaken may be held to be odious debt, which might permit it to be disavowed without any effect on a country's credit status. This includes any loans to purchase assets, such as leaders' palaces, or the people's suppression or extermination. International law does not permit people to be held responsible for such debts, as they did not benefit in any way from the spending and had no control over it. Determine if any future entitlements are being created by expenditures. Financing a public swimming pool, for instance, may create some right to recreation where it did not previously exist, by precedent and expectations. Problems. Sovereign debt problems have been a major public policy issue since World War II, including the treatment of debt related to that war, the developing country debt crisis in the 1980s, and the shocks of the 1998 Russian financial crisis and Argentina's default in 2001. Not all developing countries have been affected to the same extent. For example, Yugoslavia had low government debt until its breakup and the coming of democracy, when the new national governments started to borrow money from the IMF. Croatia has a government debt of $47 billion today, while the whole of Yugoslavia in 1980 had debt of $14 billion. Global debt is of great concern since interest payments can often place great demands on governments and individuals. This has led to calls for universal debt relief for poorer countries.